How can subtle property use changes trigger a property tax audit? Imagine noticing a small change in how your property looks or functions and suddenly facing questions from tax officials. That's because even tiny shifts in property use can catch an assessor's. When property owners alter how they use their property, it can impact its classification or value. For example, turning part of a home into a home office, renting out a room, or converting a garage into a living space are all subtle changes. These might seem minor but can lead to an audit if they are not properly reported. Tax assessors keep a close eye on property characteristics and reported uses to make sure the property is taxed correctly. If your property use shifts and you do not update your records or report these changes accurately, it can raise red flags. For instance, if you start renting out part of your house and do not update your property records or tax filings, assessors may suspect you are claiming deductions or exemptions you are not entitled to. Another common trigger is inconsistent or missing documentation. If you change your property use but do not keep or provide leases, permits, or zoning approvals, it looks suspicious. Proper records show that your reported use matches what is actually happening. Without proof, auditors might investigate further. Misclassification is also a concern. If you claim a space is for personal use when it is rented out or used for business, it can lead to an audit. Tax rules differentiate between residential and commercial use, and mixing these up can cause issues. For example, claiming a home office deduction without proper documentation, or if the space is primarily rented out, can trigger scrutiny. Large deductions linked to use changes can also raise alarms. If you suddenly claim depreciation for a newly rented space or large home office expenses, and these claims are inconsistent with past filings, auditors may question their legitimacy. It's important to keep detailed records of these expenses and use changes. Failing to report use changes promptly or not filing required updates on time increases audit risk. Staying current with your filings and making sure all changes are reported accurately can help avoid suspicion. To stay prepared, keep detailed records of any property use changes. Save leases, permits, and receipts that support your claims. Always report changes on your tax returns and property tax filings. Understand how use changes affect your deductions and taxable value. Be consistent and timely with your documentation and filings. By managing your records carefully and reporting even small changes honestly, you can reduce the chances of triggering an audit. If an audit does happen, having clear, organized records will make the process smoother. Remember, transparency and good record keeping are your best tools to stay on top of property tax management and avoid surprises.